Do you feel like no matter how much you make, it's never enough? Not only is that frustrating, it's also dangerous because the more we spend on rising costs, the less we have to invest. Not only is inflation on the rise, that's just the tip of the iceberg. President Trump just enacted sweeping reciprocal tariffs on the world. And even though he put a 90-day pause on those tariffs, we are already seeing the stock market begin to wobble. In this video, I'll break down where do tariffs come from, why are they making a comeback, and most importantly, what are we going to do about it in terms of investing? First, let's get on the same page as far as what are tariffs. You may have heard some people say that we are taxing foreign countries for their inputs. You may have heard other people say that American consumers are paying a tax. And both of these are partially right and also partially wrong. A tariff is technically the US government charging Americans a tax to import goods from foreign countries. That is technically true. But who actually pays the tariff, who actually feels the pain of the tariff, depends on the situation a little bit. The Cato Institute made a really handy flowchart here, which I'm going to put on the screen. If you want to read through the full flowchart, pause now. But I'm going to go ahead and read the 4 different scenarios where different people actually pay the tariff. In one situation, the foreign exporter really wants to stay in the US market, and so they're willing to take a hit on the cost of their goods. In this case, the foreign exporter pays the tariff. Now, whether or not this is a good thing depends on the rationale behind the tariff. If the point of the tariff was to protect an American sector or manufacturing, then it didn't work because that good is still being produced abroad. Now, if the goal was just to raise revenue, then that's a great success because the US government gets a revenue in the form of the tariff and the American consumer didn't have to pay anymore. Now, that's one situation, and that's really only going to work out if the foreign exporter is able to weather the blow of the tariff. If the tariff is so high that the margins in their business can't handle it, then they're not going to be able to eat the full tariff, maybe a part of it. If we look at the full list of reciprocal tariffs, we can see that the highest currently is China at 84%. It's on top of the existing tariffs. And then the lowest tariffs down here are at 11, 12%. So somewhere in between, if we look at, let's go towards the top. If I look at Vietnam, where they are mainly exporting lots of textiles to the US, if they can't handle a 46% cut to their profit margins, then they're not going to eat the price. They're going to either charge more to the US or they're going to try to send their goods somewhere else. The other situation is where, you guessed it, American consumers pay the bill. It gets more expensive. We still want to import from that country, and so the consumer pays. Now, another situation is where the American business pays. If we think about Walmart, they are importing not necessarily final goods, they're called intermediate goods because they are selling that good to the American consumer. Sometimes American manufacturers are importing raw materials or intermediate widgets that go into the final product. So in those cases, the American manufacturing or the American supplier, sometimes they will pay all or a portion of the tariff. It just depends on if they want to stay underneath their competition. Can they afford to take a hit to their margins? They may pay some or all of that tariff. And finally, sometimes the American exporter actually pays a portion of the tariff. And this one's a little bit strange. If America puts taxes on imports, then imports will reduce, and therefore the global supply of US dollars will go down because Americans are spending less of their dollars abroad. When the supply of American dollars goes down, it can increase the value, it can increase the exchange rates of American dollars, and this increase in value can offset the cost of the tariff. However, because imports go down and because the cost of the US dollar is now higher, it hurts exporters because now other countries are going to be less likely to pay for American goods. American goods are more expensive because American dollars are worth more compared to their currencies. In summary, it is complicated who actually feels the pain of the tariffs, but generally speaking, the higher the tariffs, the more that bill is going to be paid by the American consumer. The businesses cannot afford to lose all their profit margins. They just won't be in business. So if they're going to keep selling their products, then the products are going to cost more the higher the tariff. The first step to understanding whether tariffs are a good idea today is first to understand why were tariffs used in the past, and then why did they stop using tariffs. When I look back into the 1800s, I can see that tariffs bounced around between 60% and 20% for 100 years. And it wasn't until relatively recently that tariffs dropped to below 10% on imported goods. Up until World War I, tariffs were the primary source of the federal government's tax revenue. This also served to protect the U.S.'s new industries from foreign competition. However, during World War I, the U.S. then switched to the federal income tax, and then income tax became the primary source of the U.S. government revenue. In this chart, we can see the blue line is the total imports, while the orange line is the tariffs on imports. So during World War I, the imports dropped off massively, as well as the tariff rate. After World War I, tariffs were then restored to their previous levels, and during the 1920s, we had what we call the booming 20s. Our economy was great, things were awesome, but then in 1929, things started to change as we entered into the Great Depression. As fear is growing in the economy, people are now pushing for more protectionism. The president at the time, Hoover, then signed the Smoot-Hawley Tariff Act. In this article right here by the Office of the Historian, it reads, among other things, raising tariffs on agricultural products, but once the tariff schedule revision process got started, it was impossible to stop. Calls for increased protection flooded in from the industrial sector, special interest groups, and soon a bill meant to provide relief for farmers became a means to raise tariffs in all sectors of the economy. When the dust had settled, Congress had produced a piece of legislation, the Tariff Act of 1930, or commonly known as the Smoot-Hawley Tariff. One problem with tariffs of this magnitude brought on so quickly is it opens the door for corruption. According to the Cato Institute, tariff-seeking industries were notorious for diverting resources into rent-seeking or lobbying Congress for preferential rates with bribes and backroom deals. Corruption associated with protectionist tariff policy in the late 19th century directly led to the adoption of the 16th Amendment, which put more emphasis on bringing in revenue through federal income tax. The result of this tariff policy was a reduction in global trade by 66% during that time. And we can see how this played out with the United States total trade as a percentage of GDP right here. This decrease right here in both exports and imports is correlated with this Smoot-Hawley tariff. Yes, our imports did drop off, but our exports actually dropped by a greater percentage. And that is the problem with tariffs, is that when you hit other countries with sweeping tariffs, they're going to hit you back with retaliatory tariffs, thereby keeping the balance of trade about the same. Yes, your imports go down, but your exports go down as well because of the retaliatory tariffs. Tariffs may not have started the Great Depression, but it does appear that they exacerbated the Great Depression. And it is because of the overwhelming failure of the Smoot-Hawley Act that President Roosevelt won over Hoover in 1932, and that marked the beginning of the end for tariffs, and the liberalization of trade began, at least until now. There are many reasons being floated for why tariffs make sense today. The first is that it raises revenue for the U.S. government, which we need to do something about. So what kind of revenue are we going to be raising from these tariffs? The calculation currently shows about $1.5 trillion over the next 10 years spread out. And on this chart, I can see in 2025, we're looking at $73 billion. In 2026, $135 billion. So how does that compare to what our current spending levels are? I pull up our 2024 spending, I can see that we brought in $2.4 trillion from income taxes and only $77 billion from tariffs. To me, it looks like the tariff revenue is a drop in the bucket when we consider our deficit is growing by $1.8 trillion every year. Now, yes, a little bit will help. However, I'm more concerned about our drop in production. Our GDP is projected to drop by 1%. Incomes are going to go down. It may trigger another recession or downturn, which has other impacts on our spending. So in my mind, attacking the deficit with tariff revenue doesn't make the most sense. It's not an easy task to pick where we pull revenue from, but instituting tariffs is going to have other downstream effects that I'm not convinced on. We may have more luck reducing spending in some of these major categories or spreading out an increase in taxes across income tax, payroll tax, etc. Spreading the burden of tackling the deficit is not going to be solved purely from tariffs. But there are other reasons why the government is implementing tariffs today. A second reason is to punish other countries for unfair trade practices and the stream of fentanyl across the border. Now, if I take those two issues at face value, I haven't looked into the fentanyl crisis, I haven't looked into the trade policies of other countries, but if I just take those claims at face value, tariffs are an effective bargaining chip for getting things done as far as deals with other countries. We have already seen this in practice between Canada and Mexico. Canada is willing to revamp their border security to aid in stopping tariff streaming across the border. Mexico has pledged money to increase the security of their border so that they have less illegals coming in and less fentanyl coming in. These things do work, and we see this in the fact that tariffs are paused one day and then they're back on the next. There's a lot of uncertainty as these countries are working out different deals. Now, that uncertainty also plays into another reason why tariffs are supposed to be good today, and that is to bring manufacturing back into America. If it's more expensive to import goods, it does stand to reason that more manufacturing might come back into the country so they don't have to deal with those tariffs. However, moving major plants and manufacturing into the US is a major investment. And if I was the one making the decision to invest in massive manufacturing plants in the US, I would want some kind of economic stability. And I'm not really seeing that with the tariffs. One day they're on, the next day they're off. I don't feel like I can count on a consistent tariff playing field. I have no idea what's going to happen. And so I would be very, very cautious before I make major investments into the US solely based off of tariffs. The final reason being floated for why tariffs make sense today is to attack the trade deficit. It is true that the United States imports much more than we export. However, the first problem that I have with this is that tariffs are not an effective tool at reducing the trade deficit. Because if we implement tariffs on a country to reduce our imports, they will retaliate with tariffs of their own, thus reducing our exports. The result is that the balance of trade stays roughly the same. The second issue I have with that is, do we consider the trade deficit to be a problem? The Cato Institute did a study on just this subject, and I want to show two graphs that they really used to highlight this discussion. So first, if we compare real GDP quarterly growth rate and net exports as a share of GDP. If higher exports was correlated with more economic prosperity, then we would expect to see these two lines going up together and dropping together. As exports go up, we would expect to see GDP go up. However, if we're looking at these two lines, to me, I'm not seeing much of a correlation. And after doing the math, there is a correlation of 0.01. That is statistically negligible. There is no correlation between these two things. So that's not enough to draw the conclusion that a trade deficit is a bad thing. Second, Cato Institute shows a graph that compares the unemployment rate with net imports. Once again, if the hypothesis was correct that higher imports is bad, then we would expect to see unemployment go up as imports go up, but we're actually seeing the opposite. In this case, there's a correlation of 0.31. So there's actually a slightly negative correlation. As imports go up, we see unemployment go down in this graph. Once again, we are not seeing a causal relationship between imports going up being bad and exports going up being good. Naturally, you might be asking, well, Brian, what happens when the US continually imports more than we export? Aren't there more US dollars leaving the United States than there are coming in? And the answer would be yes, if you are only looking at this issue through the lens of imports and exports. One way that dollars fly back into the US economy is through investments. Other countries want to park their US dollars in US treasuries and US businesses because it is seen as incredibly safe. The net flow of US dollars in and out of the economy is roughly equal because of all of the investment coming into the United States. Another massive factor that affects the trade deficit is the strength of the US dollar compared to other countries. If I imagine for a second that the US dollar and the euro are completely equal, 1-to-1, and I want to import a good, then I can buy that good for $1 for €1. Great. But if the US dollar suddenly gets much stronger and now $2 are worth €1, suddenly importing stuff from abroad is very cheap if I am going from dollars to euros. And conversely, if they are trying to import something from the United States, it becomes much more expensive to make that import. So the relative strength of the dollar actually plays a much stronger role in the balance of imports and exports than does tariffs. When we see imports and exports through this lens, it's actually a mark of great economic strength that the US economy is importing more than it's exporting. It shows that there is great demand in the world for US dollars. And as long as the United States is seen as this stable and prosperous nation, then the investments will continue to roll in. This chart here shows the current amount compared to the capital account. The current account on the bottom shows the cash outflows, which is affected by things like the trade deficit, whereas the net investment, the capital inflows, directly mirrors the current outflows. So this is evidence right here that countries are investing into the United States at the same rate that we are sending money out into the world through buying cheap imports. Now, if we were to see the capital investment start to dip while the current outflows were remaining at strong, then that would be a red flag, but that is not what we're seeing. On top of that, US investors that are investing in foreign countries are making more money than foreign countries are making by investing in the United States. This graph shows that right here. And the reason for that is foreigners are willing to accept a lower return on their investments because of the safety and the security of the United States. Because Americans are actually making more money on their investments abroad, we are benefiting from the arrangement of the United States dollar being very strong, the United States economy being strong and reliable. One major contributing factor that makes the United States such an economic powerhouse, so safe and so secure, we did have free trade with the world for such a long time. Companies could start here and then count on having cheap inputs brought in from other countries and then have access to US markets. Naturally, the final question is, how do we invest going forward so that our portfolios are not as affected by the tariff policy? First and foremost, if we do experience a recession because of these tariffs, there's not a lot we can do. Even if we are investing in companies that are not affected by the tariffs specifically, if American consumers have less money to spend on goods and services, then the entire economy is going to drop, which results in most companies dropping as well. On the other hand, if we are still able to have a strong economy going forward, I am targeting first and foremost companies that have a durable competitive advantage. When companies have the pricing power to push that tariff bill onto the consumer, then the stock price is going to take less of a hit. And that is why I'm spending way less time and energy looking for companies that are less likely to be affected by tariffs, companies that don't need to import things from other countries. I'm not as focused on that as I am focused on companies with a durable competitive advantage. And the best way that I have found to do that is to use the red flags and the green flags that Warren Buffett uses when he's evaluating companies. He has been the king of value investing. He has been the king of finding companies that have this advantage that allows them to grow over years and years and years. He's famous for saying that when he buys a company, he wants to be able to hold it forever. And the way he finds those companies is by, I sound like a broken record, finding companies with a durable competitive advantage. I talk about how I use his red flags to find companies in this video right here. I hope to see you there. Cheers. Oh, that's a good one. Lily? Mala?